In 1994, the smartest finance minds in the world started a hedge fund. They had two Nobel Prize winners, the former vice chairman of the Federal Reserve, the most respected bond traders on Wall Street. They called it long-term capital management, and they believed they had cracked the code of the financial markets, using mathematics so advanced that risk itself could be measured, controlled, and eliminated. For 4 years they were right. They produced returns that made every other hedge fund look like amateurs. 21% in 1995, 43% in 1996, 4% in 1997, then in 1998. In just 4 months, this same fund lost $4.6 billion. It came so close to collapsing the entire global financial system that the Federal Reserve had to organize an emergency rescue. The smartest people in finance, armed with the most sophisticated mathematics ever applied to markets, almost broke the world. Today, I'm telling you that full story, the genius founders, the strategy that printed money, the single event nobody saw coming, the 36 hours that nearly ended modern finance, and the chilling lesson that still applies in 2026. Welcome to Earnings Per Page, Wild Money Stories, Honest Finance History. Hit subscribe. Let's begin. First, the founders. The story starts with a trader named John Meriwether. In the 1980s, Meriwether ran the bond arbitrage desk at Salomon Brothers, at the time the most profitable trading desk on Wall Street. He hired physicists and mathematicians instead of MBA traders. He believed that markets were ultimately mathematical and that the right model could find opportunities invisible to everyone else. By the early 1990s, Meriwether had assembled what was probably the most credentialed group of finance minds ever working together. Myron Scholes, co-creator of the Black-Scholes options pricing formula. Robert Merton, pioneer of derivative pricing. Both would win the Nobel Prize in Economics in 1997. David Mullins, former vice chairman of the Federal Reserve. Eric Rosenfeld, Harvard professor. Larry Hillenbrand, the highest paid bond trader on Wall Street. They left Salomon Brothers in 1994 and started long-term capital management. Their pitch to investors was extraordinary. We will use mathematics to find tiny, riskless inefficiencies in global bond markets. We will trade them with enormous leverage. We will produce stable, high returns regardless of market conditions. Investors threw money at them. The fund raised $1.25 billion before opening the largest hedge fund launch in history. Lesson 1. The strategy looked like genius. Here's how LTCM made money. They looked for tiny pricing differences between similar bonds. For example, a 29-year U.S. Treasury bond and a 30-year U.S. Treasury bond should trade at almost identical prices. Sometimes the prices got slightly out of sync. LTCM would buy the cheap one and short the expensive one. When the prices reconnected, as they always did historically, LTCM made a tiny profit. We're talking 0.1% or less per trade. So how did they turn that into 40% annual returns? Leverage. Extreme leverage. For every dollar of investor capital, LTCM borrowed $25 to $30 from banks. At its peak, the fund was managing $5 billion of equity and controlling over $130 billion in positions. A 0.1% gain on $130 billion is $130 million. Multiply that by hundreds of trades per year. The math worked, and it kept working, until it didn't. Lesson 2. The model assumed markets behaved rationally. Here was LTCM's fatal flaw. Their entire strategy relied on bond prices eventually converging back to their mathematical relationships. Historically, this was almost always true. The relationships might diverge for days or weeks, but they always came back. The model was built on decades of historical data. The mathematicians knew the formulas. The Nobel laureates had won prizes for understanding exactly this kind of statistical behavior. There was only one possibility they hadn't fully accounted for. What if markets stopped behaving rationally entirely? Then comes August 1998. Lesson 3. The black swan that broke the model. On August 17, 1998, Russia did something unprecedented. It defaulted on its government debt. Russia, a nuclear power, a giant nation, just defaulted. Markets panicked. But here's what made it catastrophic for LTCM. The panic didn't follow the patterns the models predicted. Normally, when markets get scared, investors rush to similar safe assets in predictable ways. LTCM's models knew how to handle that. This was different. This was a flight to absolute safety. Investors abandoning AL bonds of all kinds simultaneously. Bond prices that should have converged based on 30 years of data instead diverged. Spreads that had never been more than 0.5% suddenly widened to 1%. then 2%, then 3%, each widening cost LTCM hundreds of millions. The losses compounded daily. By August 21st, LTCM had lost over $550 million in a single day. By the end of August, the fund had lost $1.9 billion, 44% of its capital. In 1 month, lesson 4, the death spiral. Here's where it gets terrifying. LTCM was leveraged 30-1. When losses hit, their banks demanded more collateral, exactly like 1929 margin calls. LTCM had to sell positions to raise cash, but the markets were thin. Their positions were enormous. When they tried to sell, prices crashed further. The selling caused more losses. The losses caused more margin calls. The margin calls caused more forced selling. By September 1998, LTCM was losing $100 million per day. The Nobel laureates were watching their models fail in real time. They had no playbook. The mathematics that had built their fortune was now destroying it. Lesson 5. The 36 hours that nearly broke the world. By mid-September 1998, the world's biggest banks realized something horrifying. LTCM owed them money. A lot of money. Over $130 billion in positions scattered across every major Wall Street firm and many European banks. If LTCM collapsed and couldn't pay, these banks would absorb staggering losses. Some might fail outright. The collapse could cascade through the global financial system in ways nobody could predict. On September 23, 1998, William McDonough, president of the New York Federal Reserve, summoned the CEOs of 14 of the world's largest banks to a single conference room in Manhattan. Goldman Sachs, Morgan Stanley, JP Morgan, Merrill Lynch, UBS, Deutsche Bank. He told them what no one wanted to hear. LTCM cannot fail. If it fails, all of you might fail. You will pool $3.6 billion of your own money right now to save it. The room was hostile. The CEOs hated the idea of bailing out a hedge fund. They argued, they negotiated, but within 36 hours, the deal was done. 14 banks each contributed roughly $300 million in exchange for 90% ownership of LTCM. The fund survived. The crisis was contained. The wider banking system held. But LTCM was finished. The original investors lost everything. The Nobel laureate's fortune was wiped out. Final lesson. What this story really teaches. 3 brutal truths from LTCM. First, leverage is the only thing that turns small mistakes into total disasters. LTCM's strategy was actually correct on a fundamental level. Their problem wasn't that they were wrong. Their problem was that they were leveraged 30-1, which meant a small period of being wrong destroyed them entirely. Second, past data is not future certainty. LTCM's models had been backtested over 30 years of market history. They worked, but 30 years of data is just a tiny slice of all possible futures. A single event outside that data, like Russia defaulting, exposed the model's blind spot. Every quantitative model has the same flaw. It can only know what it's seen before. Third, intelligence is not protection. The smartest people in finance lost $4.6 billion because they confused their model with reality. Markets are not equations. They are human emotions, panic, fear, and irrationality at scale. Even Nobel laureates can't math their way out of human behavior. The story of LTCM is the story of every financial crisis that's followed it. 2008 wasn't a different kind of crash. It was LTCM at a larger scale, geniuses with mathematical models that didn't account for human panic. 2020 wasn't a different kind of crash. It was a faster LTCM, and whatever the next crisis turns out to be, somewhere, right now, there are brilliant people convinced they've solved the problem of risk. They haven't. Nobody has. Nobody ever will. If this story stayed with you, subscribe to Earnings Per Page. Next time I'm telling the wildest hedge fund story of the past decade, the FTX collapse, and the man who lost $8 billion in 8 days. Drop a comment with whether you think markets are smarter now than they were in 1998. See you in the next one.